Hey everybody, good to be here today. My name is Brent Moores. I'm sitting in for Cam today. This is his normal class. He's just out for today. He'll be back next week. And trading calls and short puts. We're going to focus on the latter today, short puts. So I want to talk to you about the versatility of them and just give you some examples of some different ways to use them, different considerations as you're considering them. They're a strategy. I mean, I can't recommend any particular strategy. We'll say a lot of traders, as they're venturing into the realm of options, they find that short puts can be pretty attractive to them in that regard. So, well, hey, before we get too far, let me just mention this. Barb Armstrong is joining me in the chat. Appreciate Barb. And she's a wonderful instructor. Make sure you follow her on X. And you can follow me as well on X, at Barb Armstrong, CS, at Brent Moores, CS. Also check out some of Barb's other webcasts there, including a Trading a Smaller Account webcast. But hey, before we get too far into it, let me just go through some disclosures. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not an individual recommendation or endorsement of any particular security, chart pattern, or investment strategy. This webcast discusses technical analysis, and we will use technical analysis today, but it is not the sole means of investment research. I'm probably not going to factor into commissions into our trades, but just realize there's something to think about. Short options can be assigned, and that's what we're going to be talking about today is short options, short puts. They can be assigned at any time up to expiration, regardless of the in-the-money amount. All investment involves risk, including the potential loss of principal. The paper money application is for educational purposes only. And there you go. I think those are kind of the main points I wanted to hit here. We'll start off, take a look at the markets just to get us started, but then we'll, I don't know what to say on the markets you guys haven't already heard. It's trending up. It's been trending up. This is a 20-day moving average. The stock has been over the 20-day moving average probably like 98% of the time over the past several months since late April. So, the market has been more bullish, and when we're doing short puts, they're a bullish trade. Okay, that's what they are. There's risks on them. There's pros and cons, and the first thing I want to mention with short puts is this. Do you remember there was an old I don't know, jingle or advertisement for, I think it was McDonald's. Was it McDonald's? Have it your way. In other words, if you order a burger, you can have it with ketchup or mustard or whatever you want, or you can customize it. Well, here's the thing with short puts. One trade, there's a lot of different ways to do them. Maybe you're more aggressive. There's a way to do it. Maybe you're more conservative. There's a way to do it. Maybe you're more longer term, or at least intermediate term, or I guess maybe long term. Maybe you're short term. There's a way to do your short puts there. And I want to talk about some of these different ways. One thing to consider is we are going to have earnings season coming up pretty soon. And so we're going to have a lot of companies coming out with earnings that may or may not impact your decision on your trades for your short puts there. Okay. So there you go. I saw in the chat, Kevin said short puts are probably my favorite after long stock positions. They're a common way that people like to do it. There are risks, and I'm going to emphasize, and we're going to talk about the risks today, but that's kind of my intro spiel there. Okay. Let's talk about short-term, long-term. A lot of it's probably going to come down to your technical analysis. If you are short-term bullish, you may consider just a short-term short put to try and bring in some extra income. Okay. If you're long-term bullish, you may still go shorter term on the expiration date, but you may be more inclined just to buy the stock. Okay. Let the put be assigned to you. If you go in with the idea that if I get assigned this stock, that's a good thing. That's not a bad thing. I want to buy this stock anyway. then it really takes a lot of the complication out of the trade. It doesn't take the risk out of the trade because that stock can still go down to zero, but it does take some of the complexity out of the trade. If you're just saying, "Hey, I'm willing to buy the stock," there's no there's no management in terms of when to get out or whatever. You can let it go to expiration. That's the way to do it. But remember, anytime you do a short put, you are obligating yourself to buy 100 shares of stock per contract, okay? And you can do it as a cash secured put. In other words, you have the cash on hand to buy those 100 shares of stock, whether you ultimately buy it or not, or if you're approved for the appropriate options approval and you have a margin account, then you can possibly just do it on margin as well. But just never forget the underlying obligation that you have when you sell these puts. So let's look at some examples here. So I'm going to go to a very, obviously a very popular stock. And generally with short puts, as with probably most option trades, very, very commonly, we're going to look at technical analysis. So I'm just going to write TA here. Technical analysis is going to be the key to this. However, if it's a trade where you're trying to buy a stock for the longer term, maybe you're going to consider the fundamentals of that stock. I'm probably not going to focus on that as much today, but just realize if you're focused on, hey, I want to buy this stock for the long term and I'm going to use a short put as a means to do so, you may consider things like earnings growth, sales growth, margins. You may consider valuations, PE ratios, price to sales ratios, things like that, debt levels. That probably factors in. Those fundamental analysis type things are going to factor more in. You're planning on buying that stock and holding it for a longer term. Okay? But for our purposes right now, I want to talk about the technical analysis of this. And the technical analysis, first I'm going to look at the trend. What's the trend on Apple doing? The trend on Apple is going up. Okay? If you are struggling with looking for higher highs and higher lows, sometimes that gets a little bit more iffy because you get some that are a little bit uncertain. You get a lower high mixed in with a bunch of higher highs. You can always use moving averages to help you. I have a 20-day, a 50-day. You don't need to use those. But if the stock is going above both of those and those are sloping upward, probably most people would consider that in an upward trend. Okay, so that's my thing. I'm going to say this is going to be a bullish trade. Now, I mentioned earnings season. Excuse me, winter earnings. Well, one thing you can always do is you can look on the chart and say, do I see earnings? I don't see it right here, but it may not be far off. So you can go to the Analyze tab, Earnings sub-tab, earnings scheduled at the end of the month, October 30th. Okay, so October 30th. So I'm going to look to do something and get out before earnings. You don't have to do it. If this is a longer term trade, I don't see a strong case of needing to avoid earnings. I'm planning on buying this for the longer term anyway, if that were the case. But that's not the case in this case. I'm planning on just doing a short-term put before the volatility of earnings hits. Therefore, if I go to my trade tab, I'm going to pick something before expiration. Expiration was October 30th, if I remember correctly. And here's October 31st. Is that before earnings or after? That's going to be after earnings. You know how I can tell, besides looking at the date, is look where the implied volatilities take the jump up. Here, the implied volatilities all of a sudden boost up. That's usually a pretty good sign earnings is occurring in there somewhere. And in that case, I think it was October 30th. So in order to avoid earnings, I'm going to go before that. We're just going to go to October 24th, 18 days to go to expiration there. There we go. And I may have gotten the fast food restaurant wrong before. It was Burger King. Okay, was that the Was that, maybe it was Burger King, not McDonald's. Anywho, let's go on with what we need to, and that is looking at this trade, October 24th. Then the question is, so that's the time. The question is how, if I'm trying to not buy this, I'm probably not going to be super aggressive with this trade. In other words, I can use, say, for example, Delta as a way of giving us an idea on that. Or you can also use a technical analysis. Delta tells us how much the option moves in relationship to a $1 move in the stock price, but it also can give us kind of an idea of the probability of the stock being below a certain level, in the case of the puts here, on a particular day. So the stock's at 255, which, by the way, maybe I should mention, have I not mentioned already? 100 shares of stock is my obligation. A $255 stock, that's almost better part of $26,000 obligation here on this. So if that's too rich for you, this probably is not the trade for you. Okay, that's fine. No shame in that. That's a lot of money. But just so some of our other examples, we'll look at some lower price stocks there. Okay. But I can go, well, how far out of the money do I want to go on? Well, if I go to something maybe closer to a 30-ish delta, that means there's a lower chance of that getting put to us. You can look at the chart and see, well, maybe there's some support level here. Well, I would say this is kind of a likely support level. Likely support levels aren't guarantees. But when a stock flags up and comes down, tests a certain level, that level being about half that candle in this case, and then bounces up from that, I think most technical analysts would say that's a likely support level on that. So I'm going to call that, that's around 251. I'm going to look to go below that. We can view this as kind of a protection level, so to speak. In other words, maybe it's less likely the stock is going to go below there. So I'm going to go to 250, which coincides with the delta of about 31. That's fair enough. How much premium am I going to get? When you're doing a short put, one suggestion I would make is consider your premium. I'm just going to look at the bid price here on this as a percentage of, say, the stock price, or you could use a percentage of the strike price. Okay. Usually they're going to be roughly the same. Okay. What would a 1% return be? Well, a 1% return would be 250 or 255, okay, in the case of that. Well, where are we? We're a little bit above that. So we know our return is a little bit above 1%. More often than not, I'm not actually doing the math on this in terms of a calculator. What I do is I look at this and I use that 1% thing. So if that's 1%, that means 2% would be about a $5 return. $5 return is 2% is a pretty higher level number. Usually you're not going to get that if you're going to a delta around the 30 level. Some traders will have the approach of they're only going to do it if there's at least they get 1%. Well, probably you need to consider also how many days till expiration. There's 18 days to go till expiration. So a 1% return over 18 days, you may be going 1% isn't much, Brent, and I agree 1% isn't much, but when you factor in 18 days, maybe not terrible. Okay? Maybe not terrible. So just remember the obligation on there. All right. Now, so my goal on this first example is short-term, not very aggressive. In the sense of not very aggressive, I mean less likely to buy the stock. So I'm going to do this 250 strike. If I'm willing to buy the stock, I'm probably not going to even put a stop loss on. You could put a stop loss on if you wanted to. But remember, if you're selling, we'll say for 290, where would your stop be in terms of the option price? Remember, we're selling this up front, so your stop would be at a higher price. Maybe our stop would be at something like $4 or something. In other words, if we buy it for $2.90, we got to buy it back for $4. That would be roughly a $1.10 loss times the 100 multiplier would be a $110 loss. If you're going to do a stop, you don't have to do a stop loss. And remember, that's not guaranteed. That price is not guaranteed on that. It could be a much higher level. So I'm just going to put this in as a short-term trade. All you need to do is click on the bid price. Okay. Here we go. Natural, mid. You can go in between those two if you want. Just double check your quantity. I only want to do one contract because remember, we're obligating ourselves to buy $25,000, $26,000 of stock. I'm going to confirm and send, and I'm going to just make sure you review this, make sure the quantity is right, make sure the price looks right, make sure you're prepared for this. Now, you may look at max loss and go, that's a lot of money. It is a lot of money, but consider this. If I were to buy 100 shares of Apple, and Apple were to go to zero, that it'd be a fairly similar level there. This max loss would be if Apple goes to zero, which is probably an unlikely situation, but I can't absolutely rule that out. So I'm going to send this order. Okay, we put that in, we filled that. That's an example of, say, a more conservative, shorter term trade trying to avoid earnings. Okay, now let's go something different. Let's look at one that maybe we're going to take a little bit more of an aggressive approach on, where we're not going to avoid earnings here. So I'm going to pull up Bank of America. Now, Bank of America is a financial stock. Okay. Financial stocks generally kick off earnings season, what we consider earnings season. As I mentioned before, earnings season is coming up quick. So, in fact, we can see it's going to be right around here. What date is that? Well, I don't know. Let's see if that'll tell us there. That's the 15th, I think. Is that the 15th? Should. Come on. It's flashing on me. Yeah, that's the 15th. Okay. It's on the 15th. I'm not going to try and avoid earnings on this. When would you do this trade? Okay, so this is just an example trade. It's not a recommendation. You would only do this trade I'm about to show you if you believe Bank of America is a good longer term type trade. Okay. Sometimes we do short puts and with the intention of not getting put the stock. Here, let's make it in a more aggressive approach and actually have the idea that it's going to be very likely we're going to buy the stock here. And the pro on that is we're going to be able to get a higher premium. Okay. We're going to give get a higher premium on this. So here's what I'm going to do. I'm going to go Bank of America stock after earnings, and but not too far. Earnings we said was on the 15th. I'm going to go to trade, Bank of America. I can even go to, say, 11 days out. That's not very far. How much premium can you get over 11 days? Well, let's go here. Let's go to our puts. Let's look at that delta. And Kelly's saying you can go to maybe a 40 delta. You could. That's increasing the delta. Remember, the lower the delta, okay, absolute value of the delta, the lower the absolute value of the delta, the less probability, no guarantees, of us getting put the stock. Okay, and remember, short options can be assigned early, but it's much less likely going to get assigned if it is out of the money, but it is still possible. We can ramp this up. And notice as we get to a higher delta, look at what happens to the premiums. The premiums get higher. What if we go right pretty much at the money, 50.5? Let's look at that. So this is going to be even a little higher delta, just to kind of show, to demonstrate, than even what you're suggesting there, Kelly. But certainly you can do something in between. But I wanted to give you kind of a couple of extremes here. What's our percentage return on that? Well, let's use that percentage trick here. Okay, 50 cents would be 1% of the stock price, or if we did this, it'd be about 1% of this, right? So a dollar premium would be 2%. We're at $1.22, so that's what, about 2.5% return. So generally, to get a 2.5% return, you're either going to have to go longer term, which this is not because this is only 11 days, or more aggressive in terms of the relationship of the strike price to the stock price, which this is, 2.5% return. So I said, some traders look for a 1% minimum return very often with these short puts, just as kind of a general guideline. Believe me, you can break it. There's pros and cons. It's not, but if you're new at this and just want to practice, maybe look for something, a 1% return, a little higher. If you're starting to get more than 2% return, just kind of ask yourself why that would be, why it would be such a high return. It could also be super high implied volatilities. Now, these implied volatilities are going to be a little higher because, hey, we got earnings we're going to be dealing there. Now, we're actually going to lose a little bit money buying the stock at 50.50 versus if we just bought it right now, okay, about 18 cents difference. But we can make that up in terms of premium there, okay? You can go to the $50 strike if you want. Either I'm going to stick with this 50.50. It's going to give us essentially the same thing. But this is giving us a 2.5% return if we don't get called out, or put the stock, I should say, assigned the stock. If we don't get assigned the stock, a 2.5% return over 11 days, okay? If we do get assigned the stock, which is quite likely, okay, that's okay. That's, if you go in with the attitude that I'm fine buying, this is a good long-term buy, if that's your attitude, then hey, you buy it, let it go, and if it dips a little bit, you're buying at a, what's the effective purchase price? I'm not talking taxes here. I can't talk taxes, and this is not your tax liability or anything like that. This is what I'm saying. What's your effective purchase price on this? If I buy it for $50.50 but I bring in a premium up front of, I'm just going to make it easy with $1.25, that's going to make my kind of effective, one way to think of it, purchase price of $49.25. Okay, so that's just one way of thinking of it. $49.25. So in other words, we're paying effectively as if the stock were down here. Okay, if you factor in the price of the stock and the premium of the option, both together, intertwined. Okay, if you want to view it that way. But again, we have earnings on that, so it could dip down. If your feeling is, I don't want to buy it if it's dipping down on earnings, don't do it. Another way to consider these trades is this. One approach, and we'll get to this in a sec, actually, one approach that people use is they'll put in a limit order on their buy. They want to buy Bank of America, for example, and they say, oh, I only want to buy this if the stock dips down to $49 or something like this. This is kind of an alternative to that, all right? Okay, R1 says if the stock's assigned, you get to keep all the premium. Yeah, you get to keep the premium, sure. So let's say, that's a good question, R1. I'm sorry I didn't make that more clear because it's something I should have addressed. Let's say the stock drops to way down, to $46. Not great, okay? Stock drops all the way down to $46. Obviously, that's not what the intention is necessarily on this. We bring in that $1.25 premium times the 100 multiplier, $125 premium. We end up buying the stock for $46, okay? So we're down, we ended up buying the stock for $50.50 because that was the strike price. But then the stock is at $46. So we're kind of in the hole on the stock, aren't we? Well, we get to keep the premium. It doesn't totally make up for the deficit we have with the stock, but it doesn't hurt. I'd rather have the $125 than not have the $125 in that case. So there you go. Okay. So let's go and do this trade here. All right. So I'm going to 50. There we go. I'm just going to buy this. Now, before I talked about with the other one, just sell this put. I talked about stop losses. This scenario here, it doesn't seem likely you'd put a stop loss in this because the intention is to buy the stock. That's why we're so aggressive with this. Now, sometimes, before I send this, let me just mention this. Sometimes people will say, well, I really want to buy the stock. Because the way we have it right here with this delta around 50 is it's only kind of a 50-50-ish type proposition. If I really want to buy the stock, why don't I sell the $53 put? The answer is you're likely going to come to the conclusion that you're better off if you really want to buy the stock that badly, just buying the stock right now on that. Because you can go, well, look, there's a nice big premium, but really, all you're benefiting is the amount of the extrinsic value of these. What's the extrinsic value? Well, we can always look up here and go, here's extrinsic value. And here's the extrinsic value. Notice here we sold for the highest extrinsic value. But as you start to go deeper and deeper in the money, that extrinsic value really kind of diminishes. So that's why typically, if you want to buy the stock really badly, most traders don't just sell a deep in the money short put. They'll actually just buy the stock in that case. But there's pros and cons to everything, so be aware of that. So let me go back to that trade, which I think I got rid of. Let me try that again. I'm going to click on it, double check your quantity, confirm and send. And then I'm just going to send that trade, okay? There we go. All right, so we filled that one as well. Okay, let's go and let's look at another kind of scenario. We went the real kind of conservative route in a way. We went the more aggressive route in a way. Here's another kind of case scenario, I guess, of this. Now, some of you are going to object when I give you this example because you're going to say, Brent, don't try and catch a falling knife. Fair enough, okay? And if you don't want to do a trade when something is dropping very significantly, I'm not going to argue with that. Typically we don't do that. But I want to give you an example of a couple things. One is there's an approach to trading where you may say, look, I'm bullish on this stock longer term. It's a lot cheaper than it was. I mean, we've dropped like 20% over the past, maybe not 20%, but over 10% over the past month. If it keeps dropping, at a certain point, this is going to be kind of a deal, perhaps. Now, it may not. It's not a deal if you buy this at 25 bucks and the stock keeps on going down to $10, of course. But this is just kind of an example of a situation of if you see a stock dropping significantly, one approach that people will do is they'll say, well, I'm just going to do a buy limit of this stock down at the $25 mark or the $24.50 mark or whatever mark you put in. And that way you're saying, look, I'm just going to set about that. I'm going to forget it. And if the stock happens to fall down there, dip down there, I'm buying it at an even cheaper price than it is now, $26. This falls apart though if you're not bullish longer term on this. If you're going to trade the trend, you'd wait for the trend to reverse on that. Okay? So there we go. Now, let's go And let's just kind of look at what we're talking about here on this. I'm going to go to the trade tab. And actually, let me look and just well, let's do this. Let's look here and see if we can figure out where, look, earnings is probably between these two strikes. We can double check exactly. In fact, I think someone in the chat said earnings on October 22nd. Okay. Now, we knew it was coming out somewhere in that range because that's where our implied volatility increases. Okay. So Deepak says, should we wait till earnings results to see what they are? Maybe. If your case for bullish long term on a particular stock such as AT&T is going to depend on what those earnings are, then yes, you would wait. But if your feeling is, hey, look, I think the stock may do just fine on earnings, number one. And number two, even if the stock goes down on earnings, I think fundamentally, even if earnings aren't very good, I like the turnaround picture for the particular stock, then it may make sense to do it. But in this case, what we're going to do is we're going to look, I'm just going to go out 11 days again, now that's a little bit shorter than we often do, okay, because of earnings. Or maybe we go after earnings here. Maybe we go out 25 days. Give us some more time on this. Give it some more time for the stock to potentially drop. What kind of premium could we get if we let it go all down? Let's say we thought, oh, maybe the $24.50, $24 level made sense. Does it make sense from this? If we went to the $24 level, what kind of premiums are we getting? Well, if we go mid-price, 24 bucks, just a smidge under a 1% return on that. That's if the stock stays where it's at. Now, using the delta as kind of that example, there's less than a 20% chance as far as the reliability of our measure goes, which is no guarantee. There's only a 20% chance that we're going to get put this stock anyway. Technically, you can get put the stock even if the stock is out of the money, but 20% chance of it going in the money, put it that way, okay, or a little less than that perhaps. And we can get a 1% return. If it doesn't, if the stock goes up, we get the 1% return. If the stock goes sideways, we get the 1% return. If the stock goes down a little bit, we get the 1% return. If the stock goes down a lot, we're buying it for 24 bucks. Okay, and we get to keep the premium. That may not be such a bad thing if you think that's a value. So whatever trade you do in terms of these short puts, whether you're more aggressive, longer term, shorter term, think through the scenarios. Stock goes up, stock goes sideways, stock goes down, and ask yourself, there's always going to be risks. If you don't see the risks of it, then don't do the trade because there's risk that you're not seeing in that case. Okay. But if you see the risks and you go, but if I look at these scenarios, all in all, it makes sense for what I want on the trade, then this is a trade I'm going to do. So this is another case use, I guess, of your short put strategy to fit your type of trade. Okay? So let's do it. Now, one thing, just like with any other option type trade, short puts, no different. Double check your bid-ask spread. It's a penny wide. That's good. We're going to click on this. And now, one nice thing is, it's a 20, we're agreeing to buy a $24, the stock for $24. That's our premium. That's our strike. And so how much is that? It's $2,400, which sounds a little more reasonable for a lot of traders than say the what was it on Apple, $25,000 or something like that. We were looking at $26,000, $27,000. So there you go. So I'm going to confirm and send this. Now, and so we've done that. Management on these. When we talk about management on these trades, If it's a stock you want to buy anyway, you're going to do nothing. In our first scenario, which we did on Apple, we may decide we want to buy it back if it starts to go against us enough. Okay? Realize, though, if you buy it back, there's no guaranteed market, but likely you'll be able to buy it back. It's just a matter of what price you can buy it back for. So in that first short put example, let me just pull up Apple here somewhere. Should be under unallocated. There's Apple. So you can see, here's the trade. When you have a short put, it's going to show as a negative quantity. Okay, we're short, negative quantity. We got 18 days to go. We sold it for 284. Right now, it looks like we'd buy it back closer to about 270. Great, we've made a little money so far on this. Well, we haven't made anything. We have an unrealized gain, so to speak, on this. But that doesn't matter. This can be very volatile and flip up and down. Don't freak out if it's down a little bit. Bank of America is down $3 on us right now. Don't worry about that. But at a certain point, this may go against us enough. And maybe I'm going, well, I don't really want to buy the stock. So in those scenarios where you don't want to buy the stock and we go in the money, or it looks like it's going to be in the money, we may look to buy it back. The challenge is, what is the mark price going to be at that point? It's going to be a lot higher probably than 284. Okay? At that point. Maybe it's $4, $5, $6. I don't know. It just depends on how far the stock goes down. So it's likely you can get out of these, but it may cost you and you can lose a lot of money. How much money can we make? The most money we can make on this is the initial premium, 284 in this case. What's the most money we can lose on this? A lot of money is the answer. A lot of money. This is a very, very low return on risk type trade. And so when I start talking about 1% return, we stand to gain 1%, we stand to lose, the 99% of that, or, the 100%, right? We could lose the whole cost of the cost to buy, the difference between the strike price and the stock price. In other words, because that didn't come out of my mouth right, if we sell this for 284, you can lose a lot more than 284 on these. Okay, so just be aware on that. Okay, so in general, I want to kind of wrap this up. Okay, but Chris said, is there a rule set for buying back? I don't have a specific rule set, but let me give you some generalities for you. Number one, in most cases, if you enter the short put trade with the idea that it's a stock you like, it's a stock you want to own, you're just trying to bring in a little extra income on it, then there's not really a concern on buying back the short put. You can just let it go, and if it goes in the money, you buy the stock, no problem. And then you manage it just as you would any other stock. Okay, then you have the stock, you manage it as you would any other stock. If you do a short put, where we kind of gave that example today with Apple, where your goal is not to buy the stock, if it gets to the point where you're pretty confident you're going to end up buying the stock, then you're probably going to buy it back at that point. What could that be? Broken support, broken trend, likely a technical analysis break of some sort. Just a change in forecast is going to be the case there. So not necessarily what the price is down here. More likely, I think for a lot of traders, it would be the break here. So in this case, when I said, here was our support level with Apple, maybe put a buyback point down here some way, okay? So there you go. Now, what about buying back if things are going well? Okay, and Barb just addressed that in the chat, but this is a good point for everybody. What if things are going well? Number one, you can always let it go to expiration if things are going well. But if you don't want to risk buying it back, but you don't want to risk it, going against you hard in the last part of the trade, and you end up buying it, then as Barb mentioned in the chat, for those of you not watching the chat, she said, maybe if you've made 80% of what you can make. Well, what's 80% of what you can make? 80% of what you can make is your trade price times 0.8. So, and so if I could buy it back for 284 times 0.2, if I could buy it back for 56 cents, then I've made about 80% of what I can make. So there you go, everybody. I'm hoping that, I just wanted to show you, my goal today was to show you versatility of these. You could be more aggressive with them. You can be more conservative with them. You can avoid earnings. You can go into earnings. You can do it with the express intention of buying the stock. You can say, I'm just going to nibble away and do a lower delta. Try and bring in a little premium along the way, but my intention really isn't to buy the stock. All right? So there you go, everybody. Thank you very much for joining me. Thanks, Barb, for helping me on the chat, of course, as always. And coming up next, got Liz Ann live at the top of the hour there. Cam should be back next week. Thanks for joining me. Remember, subscribe to that Trader Talks channel. If you're on YouTube right now, you're looking at a webcast that's on that channel, but just subscribe, and that way you don't miss future webcasts that are of interest to you. And make sure you follow us on X. And everybody have a wonderful rest of the day. And we do appreciate your likes, by the way. So everybody have a great day. Bye-bye.